Hey guys, it's Sebastian from AskSebby, and today we are going to look at the current credit crunch that we're seeing, some things that you might want to do before it's too late, and then how it can lead us into a credit crisis. As a starting point, give this a thumbs up, and if you are someone that's not subscribed, consider subscribing to the channel and turning on notifications via that little bell icon. So what is a credit crunch and why do I think we are in that right now? A credit crunch is when we see a sharp decline in lending by these institutions to either other businesses or to people. So if you think of this as lending and the lower bottom tier is going to be the higher risk stuff and the top one is the less risky stuff, we're going to see this turn into this. So the bottom level is not going to get anything while the top level is still going to end up getting some money in terms of the lending. So cool, that's a nice visual example, but why do I think that's happening? You can actually look into the news right now and there's a lot of different data points issued directly from the banks. On the mortgage end, we've seen Chase increase the requirement for the down payment as well as the credit score. So right now, if you want to get a mortgage, you're going to need to have at least a 700 score, and then the minimum down payment is going to increase from 3.5% up to 20%. 3.5 to 20 is a pretty big jump. That's pretty much sixfold. We've also seen Wells Fargo as well as US Bank increasing the minimum requirements up to 680, even for VHA and VA loans. The reason that matters is typically for those, you only need a 580, so 580 all the way up to 680. You might be thinking, well, I'm with a credit union, I'm with a pretty good one. They aren't going to do anything to screw me over, right? So if we look at Navy Federal Credit Union, they're actually going to be suspending FHA loans for the rest of 2020, and they're hoping to bring it back in 2021. So we see all of these issuers increasing the requirements, so only focusing on that top level or just removing a product entirely. The removing a product part is pretty important, and we'll cover that with the credit crisis bits. Quick tangent, but there is that secondary argument that, well, if you don't have at least 10% down, then you shouldn't be able to get a place anyways because it might be beyond your means. And I get that argument, but the fact that we're seeing such a big increase is more of the thing I'm concerned about rather than whether it's morally right or wrong to give someone a mortgage if they don't have that level of assets. You might be thinking right now, well, this is only on the mortgage end, which is traditionally longer term, so they do want to de-risk, but what about the credit card side? So over on this side, we are seeing increases as well, but they're not going to be as publicly announced. A good example of this is going to be a Citi balance transfer card. Reminder, when you think about balance transfer cards, they're pretty far down on the list. So right at the bottom, you probably have fee harvester cards as the easiest ones to get. And then one step above that, you have secured cards, student cards, and balance transfer cards. This isn't a normal cashback card. It's not an intro travel card or an intermediate travel card or something like a Chase Sapphire Reserve or Citi Prestige. So the top level card, this is pretty far down. So with the Citi Diamond Preferred card, right now, they're looking for people who have a 740 to 850 credit score. This is as of April 15th, 2020, and this is with creditcards.com, which works directly with Citi, and Citi probably tells them what to put on their site in terms of requirements. If we hop into a time machine, so the Wayback Machine, we can look 2 weeks back. 2 weeks ago, they wanted a 670 to 850 score. Same exact card, same exact platform, but the score increased from 670 to 740. That's a 70-point jump in terms of the credit score. And yes, I realize that if you have below that 740 score, it's not a hard limit, you might still be approved, but the fact that what they're expecting increased so substantially is pretty worrying to me. What if in another 2 weeks it goes from 740 to 780? So we're currently already here. What if we take that next step? So what if this becomes the new reality? Given this, I think if you are someone that wants a new card, whether it's for a balance transfer or whether you want to lock in a bonus, now, this week, is going to be the time to get it before it's too late. I might be completely wrong, and maybe in a week or two we are back to normal, but it doesn't feel like that. For me, I'd rather de-risk if I have property taxes, HOA fees, rent to pay anyways, just because hitting those things make hitting minimum spends a lot easier for me. Before we talk about the credit crisis bit, if you are someone looking for a new card, or pretty much any other financial product, if you want to support our channel, we do have links that are on our website, AskSebby.com, or down below in the description box. Make sure the links are competitive, obviously, with the other offers you can find elsewhere, but otherwise, it's a very easy way to support the channel. I'm going to pull the official term for credit crisis because I think it's pretty important for this. A credit crisis is the breakdown of a financial system caused by a sudden and severe disruption of the normal process of cash movement. In our case, it means that people are not going to repay their loans, whether it's credit cards or mortgages. We did see this back with the other financial crisis where people had mortgages that they couldn't pay, and then we had the banks foreclose on those homes and have to sell them at a loss. Last time we saw this at a pretty big scale, so it wasn't one domino falling, it was a lot of them falling at the same time. A credit crisis is caused by the trigger events such as unexpected and widespread default on bank loans. Credit crunch becomes a credit crisis when lending to businesses and consumers dry up, with cascading effects throughout the economy. So if this becomes this little bit, in our case, it means that the credit card companies won't actively be looking for new people. Same thing with the mortgages. It might not be explicit though, so you might not see them saying that, hey, we don't want people applying for this card, but they might do things to incentivize people not to. This might be removing intro bonuses entirely, raising the requirements very substantially, or just making it more difficult. Maybe you already have to have a credit card with them, and you have to have a bank account with them for at least 1 year. And some of these can feel very arbitrary, and I'm looking at you, Bank of America, for the payroll protection program. We aren't there yet, so don't stress out too much, but we are seeing a few signs that this is likely to happen or potentially going to happen. Overall, we've seen a lot of the bank stocks lose more value compared to other ones in the market. JP Morgan Chase is down 30%, Wells Fargo is down 42%, Citigroup is down 43%, and Bank of America is down 33%. The thing with share price though is that this can obviously change in a week, and things are changing pretty frequently in the market right now. And the other weird part about this potential crisis is we're seeing the stock market recover quite a bit while we're seeing normal people still struggle. So depending on who I talk to, if I talk to people who are investing in the market, who are buying the dip, they're like, hey, the market's doing great. We're almost back into the SPY 300 level. They bought the dip and they're up 10 or 20% in a week or two, so they're in a pretty good spot. With normal people though, they're feeling it quite a bit because they can't actively work. They are getting some protections right now, but in a month and 2 months, what happens then? At some point, is everyone just going to become a YouTuber or a TikTok star or something? Because that's the only thing you can do. The things that we do know though that are a bit more firm is that Chase is not having a good Q1 and they're expecting a pretty bad Q2 and Q3. A lot of these financial institutions are putting money off to the side, expecting write-offs and defaults. I'll put up some screenshots from the news, but it's quite a bit of money and the default expectation is pretty high. Again, we're not here yet. We're not at that point where it's happened, but people are protecting themselves and they're expecting a storm. The hurricane's coming, they're preparing for it, but oftentimes you don't really know how hard it's going to hit. So cool, that's the banks, but what about you? What about the average person? How are you going to position yourself to make sure that you don't get screwed? As you can tell, there's a lot of dominoes that are happening, so they're expecting losses, but if the loss projection exceeds what they're planning for, then what they're going to start to do is either decreasing credit limits or just outright closing accounts of people they feel are risky. And for those two things, we might actually see them sooner rather than later, even before that happens, if they feel that it's getting a bit too close. For me, I think the issuers that are most likely to do stuff like this is going to be the ones that don't really have other revenue arms compared to just credit cards. So when we look at JP Morgan Chase, they have investment banking, they have trading arms, they have mortgages, they just have a lot of other things than just lending money. So even if credit cards are down, even if they're expecting a lot of defaults, they might make money on their investments and their portfolio management services. With other issuers like American Express though, or Capital One, or these other issuers that are very credit card based, yes, they might have saving accounts, but it's a relatively small amount of their business. The other side of the coin is going to be the issuers that focus more on subprime, which tends to be issuers like Capital One. If you have cards from any issuers, but especially Capital One and American Express, they're probably the ones most at risk of doing financial reviews. Capital One, from my experience, doesn't have any process like that, but I wouldn't be surprised if they implemented one, and American Express has one that's pretty well known at this point, where when they put you into a financial review, they typically want 2 years of tax information via the 4506T. So they want to see that you make as much as you actually say you do. For that one, if you don't submit that, then they typically just blacklist you and close down all of your accounts. If you get that, I'd strongly recommend completing it because otherwise you're pretty much losing out on a lot of really good cards that have a lot of value in the long term. Other issuers like Chase, in the past at least, have just shut down people's accounts when they feel the risk is too high. So instead of decreasing the credit limit, instead of doing a financial review, oftentimes they just close down all of your credit cards. To mitigate against all of this, I'd recommend keeping your utilization relatively low, so below at least 50%. If you do need to use it, treat it as a pay-as-you-go card or prepay it in order to use it. So if you have a $10,000 limit and you need to make a $5,000 purchase or $7,000 purchase, maybe pay off $2,000 of it before the statement closes. This is something I've recommended a lot in my prior videos, talking about how to increase your credit score. If your credit limits are way too high, then consider decreasing them because, again, some of these issuers would rather just cut off that relationship and remove your cards rather than decreasing your limits, which doesn't really make sense for me, but that's their risk policy. End of the day, the last thing I want for you guys is to have credit cards that add value for you end up getting closed because your limits were a bit too high. Some people are very against this because they treat their credit limit as kind of a score, as a trophy to show how much of a limit they have. And I get that, but it just doesn't make sense for me. I'd rather have cards that have lower limits, that give me value, that give me rewards, rather than having just a high limit. The final thing is whether I actually see this turning into a full-on credit crisis or whether it's a short-term credit crunch. I'm kind of on the fence with this because on one hand, it seems like the market is doing very well, and then on the other hand, a lot of very smart people I know who work as developers are getting furloughed. 2 weeks ago, 4 weeks ago, tech felt very insulated and safe, but if you look at a lot of other startups and tech companies or direct-to-consumer companies, it's just a lot of layoffs and a lot of firing. The reason being that a lot of these products are based off people actually going out and either working out or traveling with luggage, stuff like that. And if that's not happening, then what's there really to do? But that is kind of isolated and kind of a very specific bubble. There's obviously other companies that are thriving through this, Zoom, as well as the food delivery companies that are doing pretty well. So we have two different sides and two different outlooks. I don't really know which way we will lean. If the market keeps going up and we go back to SPY 300, then that's going to be very interesting, especially if the economy doesn't open back up. Side note, if you are someone looking to start investing, I'd consider something like Webull where you can get 2 free stocks by trying out their platform and putting $100 in. Like with a lot of people, I'm hoping that it's going to be a short-term thing, but I'm preparing for it being a long-term one. Hope for the best and plan for the worst. My question for you guys is, what are your thoughts on this? Do you think we are going to end up in a credit crisis? Let me and the community know in the comments down below. If you liked the video, give it a thumbs up. If you know anyone else who'd benefit from what we just talked about, share this with them. It'll probably help them out. But otherwise, hope you guys liked it. See you guys next time.